Hello and welcome. In this lecture video, I'll be talking about the analyzing and reporting process. This is the beginning of your Chapter 2 notes, which is on page 21 of your course pack. And so I'll give an overview of the analyzing reporting process, also to kind of give you a refresher on asset accounts, liability accounts, equity accounts, and then also what revenues, expenses, owner withdrawals, owner and capital, how those affect equity accounts. And then we'll also do two quick check problems, okay? So we're talking about chapter 2, just to kind of give you an overview. Some of the things that we're going to chat about in this chapter are journal entries. We're going to talk about debits and credits. If you had accounting in high school, this may sound a little bit familiar. So we'll talk about how to do journal entries using debits and credits, double entry accounting. And then we'll also talk about the general ledger, and we'll talk about the trial balance and how doing the trial balance flows into creating those financial statements, such as the income statement and the statement of owner's equity and the balance sheet. Those are some of those financial statements that we talked about in Chapter 1 notes, okay? So when we talk about analyzing reporting, what we're talking about is analyzing transactions from source documents, recording those transactions. Okay, so we have to analyze a transaction. How do we know that the transaction occurred? Well, we look at the source document. And then what we want to do is we want to record those transactions. Where do we record those transactions? In a journal, okay, in the general journal. And then what we're going to do is update our general ledger, and then we will do something called the trial balance. Okay, and then from the trial balance, and you don't see an arrow here, but I'll tell you what would happen. I'll give you the great reveal. From the trial balance, we will go into creating our financial statements, okay? So understanding in this course, a solid understanding of Chapter 1 and Chapter 2, Chapter 3, and Chapter 4, if you have a good understanding of those chapters, the rest of the course will just make sense. So the core knowledge comes from these first 4 chapters, okay? Chapter 2 is very important because in Chapter 2, this is where we talk about journal entries. And that's what I mean over here. A journal entry is how we record a transaction in a journal. We talk about then posting it to the general ledger, preparing the trial balance, and then going over and completing our financial statements. So if we look over here, it says analyze each transaction event from a source document. Well, what's a source document? Well, source documents help us describe, identify, and describe transactions. So a good, and they could be an electronic or paper copy. That's what hard copy, paper copy. They're a source of accounting information. So let's give a good example here. I'm going to underline the bills from suppliers. That'd be a really good example to give you some context, okay? So let's say that we have ordered some supplies we're Mary Washington. We have to order more pencils and paper for our supply closet. So what we would do is we would send a purchase order to our supplier. Then our supplier would send us back the paper and the pencils, and then they would also send us a bill. So when we get that bill, that triggers a transaction. We have to do something with that bill. What do we have to do? We have to pay it, right? We have to pay the bill. And we would pay it assuming that the supplies that we ordered were the supplies that we received. So once we receive everything that we ordered and everything's good, then we're going to pay the bill. Just like you would with your own, if you order something from Amazon and it's not right, well, you're going to call them and say, you need to do something about that. Same thing here. So once everything that we ordered is correct, we receive what we wanted, we're going to pay that bill. So that paying that bill is an event. It's a transaction. So we have to do something with that. We have to record that transaction. And we are going to record that in the form of a journal entry in the general journal. And that's something that we will talk about in more detail on a subsequent lecture video, okay? So to think about a source document, give you context, a bill from a supplier. Mary Washington orders supplies, and we get a bill, and then we have to pay that bill. Paying that bill is an event. And what triggers that event? When we receive the bill. That's when we decide, okay, we need to pay this now. Okay. Another thing that we need to talk about is the idea of an account. Okay, of an account, and that's similar up here, the ledger accounts. So an account is just a record of increases or decreases in a specific asset account, liability account, equity account, revenue, or expense. Okay, so an example would be like a cash account. We could say the accounts receivable. Okay, those are examples of accounts, because what we're going to be doing is we're going to be keeping a record of every time cash is increased or cash decreases. Right over here, increases or decreases with a specific asset. A specific asset is cash. You know, cash is an asset. So we're going to record in our general ledger anytime there's an increase or decrease to cash. Same thing with accounts receivable. Increases or decreases to accounts receivable. That is a specific asset, and in our account, we will record increases or decreases to cash and accounts receivable. All right? So when we look over here and we define the general ledger, which is right over here, post-journal information to ledger accounts. What do I mean by the general ledger? It's a record containing all the accounts used by the company. So the cash account, accounts receivable, accounts payable, unearned revenue, prepaid expenses, equipment, machinery, buildings, land, owner's capital. Those are all examples of accounts. The general ledger is all of those accounts and then their respective balances. What do I mean by respective balances? How much cash do we have? After all the increases and decreases during the whole accounting period, the whole year, we look at the ending balance in cash and we say, this is our balance in cash. That's the balance in the account. And so the general ledger is a record that contains all the accounts used by the company, so cash, accounts receivable, all those that I just talked about, and then their respective balances. So when we talked about asset accounts, remember we talked about this back in chapter 1. What do we mean by an asset? It's something that's owned or the company possesses and expected to have future economic value. Helps us to generate revenue. So examples of asset accounts: cash, accounts receivable, prepaid expenses, and that's something we'll talk more about in chapter 3. A prepaid expense, an example would be prepaid rent or prepaid insurance. Basically what that is let's say that you pay 2 years of rent today. 2 years of rent for the next 2 years. You have prepaid over those next 2 years because maybe you only have to pay rent on a monthly basis, but maybe you get some type of discount if you pay it over 2 years. So that would be an example of a prepaid expense, prepaid rent. You pay it over 2 years or 3 years, multiple accounting periods. That is an asset. And again, that's something we'll talk more in detail in chapter 3. Supplies are also asset accounts, equipment, and then notes receivable. I talked about accounts receivable in the chapter 1 lecture video. Remember, if we sell something on account or we sell something on credit, which means that we made the sale and our customer says we can't pay you now, we're going to pay you in a month, that we would have an accounts receivable. We can also have a notes receivable. What's the difference? Notes receivable has interest. Accounts receivable typically does not. Okay. Liability accounts, just like what we talked about in the chapter 1 lecture videos. Liabilities are claims by creditors against the assets. Because remember, our accounting equation says that assets equals liabilities plus equity. Liabilities are the creditor's claims on those assets. Equity are the owner's claims on those assets. So basically its assets, as you can just see by the equation, is divided into liabilities and equity. Well, this is what the creditor's claim on the assets are. This is what the owner's claim on the assets are. Examples of liabilities, and again, you can think of liabilities as something the company owes too, owes its creditors. You don't always have to owe in cash though. You can owe in future services. All right. So examples of liability accounts would be accounts payable. So we purchase supplies on credit, right? We purchase supplies on credit. What does that mean? We bought supplies, which are an asset, okay? But we're going to pay for those supplies later, which means because we haven't paid it now, we have a liability in the form of an accounts payable. We can also have a note payable. An example of when we would have a note payable is when we borrow money from a bank. Okay. What's the difference between an accounts payable and a notes payable? Note payable has interest. Unearned revenue. Let's talk about this. We haven't talked about this before. So unearned revenue is when a company gets paid up front. So let's say that we're a legal services firm and we get paid for 2 years worth of legal services. So basically our client says, we're going to pay you up front, Henderson Legal Company. Client A says, Henderson Legal Company, we're going to pay you up front for 2 years worth of legal services. Okay. So we're a Henderson company. We got paid up front, but we can't recognize the revenue until we perform the services. So this is not revenue. It's actually a liability. It's actually called unearned revenue. Think about what that says. It's not earned yet. So it's unearned. When do we earn it? When we provide the services over the next 2 years, but not until we provide the services. Until that point, we have a liability in the form of unearned revenue. Okay. So this is getting paid up front. That's the idea of unearned revenue. Okay. Equity accounts represent the owner's claim on those assets. Just like liabilities represent the creditor's claim, equity represents the owner's claim. Okay. Remember we talked about this back in chapter 1 that there are 4 accounts that affect equity. Owner's capital increases owner's equity. Owner's withdrawals decrease owner's equity. Revenues increase owner equity. And expenses decrease equity. And that's what we see in this figure down over here. Owner's capital, which is the owner's investing money into the company, that increases equity. Owner withdrawals, owners taking money out of the company, perhaps to pay their personal mortgage. They have to withdraw money from the company. That would decrease their equity. Revenues, which are sales and other forms of revenue, increase equity. Expenses, like what we talked about back in chapter 1 lecture videos, which are costs of doing business, such as the cost of using supplies or rent expense, okay, or insurance expense or salaries expense. Those are all costs of doing business. Expenses decrease equity. All right. So let's look on the next page right over here, and I want you to pause the lecture video and do these quick check problems at the top of page 23 of your course pack, and then we'll talk about it. Okay. And welcome back. So let's see how you did. So this first one, source documents include all the following except for B, ledgers. Sales tickets. So when we make a sale, we could have a sales ticket, and that is a source document. Checks are also examples of source documents. That was included on page 1 of the notes. Purchase orders was included on page 1 of your chapter 2 notes as an example source document. Same with bank statements. Ledgers, the general ledger is not a source document. It is a collection of all of our accounts and then their respective balances. The next one, a list of all the accounts and then their identification number assigned to each account. That's called the chart of accounts. And now that's not something that I talked about, but I was hoping maybe you could be able to still reason that out by process of elimination. It's not a source document. And then a listing of all the accounts, that's not the journal. That's where we record our transaction. It's not the general journal. That's where we would be recording our transaction. But this is a similar, it says a list of all the accounts and then the identification number. It's not the general ledger, because the general ledger would be the accounts and then their respective balances. This is called the chart of accounts. And so what it looks like is maybe we have account number 101, and that is for cash. And then account number 102, and that is for AR, accounts receivable. And so this is how we would keep track of all of our accounts. It's just a numbering system, a list of all of our accounts, and then their respective numbers, which helps us to keep track of all the accounts which are then in the general ledger. Okay? All right, thanks so much. So I'm going to end this lecture video now, and the next one we'll pick up down here on analyzing and processing transactions. Thanks.